Hi everyone, I'm Anthony Hayot, CPO at Secured. I did most of my career in the traditional finance industry, doing trading, designing structured product for BNP for almost 10 years. And I'm now co-founding Secured, which is a liquidity-backed lending protocol. And we'll see in this presentation why this is the safest way to lend and borrow digital assets. But to start, let's make a quick recap on how the lending protocol works. As you may know, let's say that you own some digital assets we'll call token A, and you want to generate some passive income on these tokens. So you can deposit them in a lending pool, and they will be accessible for borrowers to borrow and pay you interest in exchange. If I am a borrower, I will come to this lending protocol, and I will have to lock some asset we'll call token B as collateral, which has a value higher than the loan that I want to make. And this is a security to make sure that I'm not going to walk away with your money. In order to maintain this security, we're going to look at the collateral factor, which is a ratio of the collateral value over the loan value, and we'll make sure that this ratio stays above a certain level that we'll call a liquidation threshold. If at a certain point in time, this collateral factor goes below the liquidation factor, then you have a liquidation process that is triggered. What happens? A liquidator will step in my place, will pay back the loan, and get the collateral at a discounted price. The loan will be reimbursed, and the lender should be good. The problem with that process, there is three problems. The first one is, for me, as a borrower, my collateral is going to be sold at a discount, which is a profit for a liquidator, but which is a loss for me. It's also a problem for the lenders, because if the sales proceeds are not enough to cover the loan repayment, then it will be a loss for the depositors. And it can also be a loss for the entire ecosystem, because if the liquidator decided to dump the asset B in the market, and imagine it's a big liquidation, then it will push downwards the price of the token B, and can make other liquidation happen, and this is what we call cascading liquidations. So liquidation is a negative event that we must try to avoid as much as possible, and we can find a collateral that is a good collateral and can help you avoid liquidation. So now let's try to think what makes a good collateral. If we want to limit the expected loss due to liquidation. If you remember your classes of probabilities, there is two ways to limit it, to minimize an expected loss. The first one is to minimize the probability of liquidation, and the second is to minimize the loss upon liquidation. So let's try to minimize the probability of liquidation. So I have a quiz for you. You have a loan in ETH that will move the value in dollar terms will move with the ETH price. This is the red line. Okay? And now you have to choose which collateral to put in front of this loan. You have the choice of a very stable collateral, let's say USDC, that will remain the same value in time, and this is the blue line. Or you can choose, for example, BTC, who has moves that are correlated to ETH. Which one for you is the best collateral? The second one. Good answer. Yeah, right. The liquidation will happen when the two lines will cross, when the red line will go above the blue line. And clearly, a stable collateral doesn't help here. What you want is a correlated collateral, and that makes the two lines do not cross. We can verify this intuition by doing what we do usually in the traditional finance industry is Monte Carlo simulation. I'm going to simulate a lot of asset trajectories with different levels of correlation from -1 anti-correlated to +1 totally correlated. And I will count the number of liquidations, the number of times the two lines cross, and the number of liquidation divided by the number of simulations gives you an estimation of the probability of liquidation. All right? So I did this simulation of a loan in A and a token and a collateral in token B with different level of correlation, and you have this curve of liquidation probability, and you can see that it decreases with the correlation between A and B. So the more the loan asset is correlated to the collateral asset, the less liquidation you will have in your protocol. This is exactly this. So minimize the probability of liquidation is exactly the same as maximize the correlation between the loan asset and the collateral asset. Second rule, minimize the loss in case of liquidation. So we've seen in the first graph that when a liquidation happens, a liquidator step in and will convert the collateral B in token A to pay back the loans. And this conversion is what you pay the liquidator for. If you make this conversion very easy, very seamless, with no constraint on timing, no constraint on size, and no impact on price, then you can give a small discount to the liquidator and we'll be fine with that. So the more you make the conversion easy between the collateral asset and the loan asset, the lower the impact in case of liquidation. You all with me? Okay, so now let's go to liquidity-backed lending. So we've seen most lending protocol, you're going to borrow ETH and have a collateral, for example, in USDC, and we've seen that in case of market volatility, this can cause liquidation, which is always bad. In liquidity-backed lending, this is what we do at Secured, we're going to use the same asset for the loan and for the collateral. The only difference is that for the collateral, we're going to use ETH that are deposited in a decentralized exchange. So we're not going to have ETH exactly in collateral, but we're going to have a LP token, ETH versus something. Okay? This LP token has very good properties. This is the token that Uniswap will give you if you deposit ETH and USDC in the ETH USDC pool. You will have a LP token, ETH USDC. And with this LP token, at any point of time, you can go back to Uniswap and get back the underlying tokens. Let's go back now to our Monte Carlo simulation. So the blue curve, we know it. It's when you have a loan in A collateralized by token B. And we know that it decreases with correlation. If I replace the collateral B by the collateral LP token AB, you embed much more correlation inside your collateral, and you can see that you have a decrease in the probability of liquidation by 20%. So it's much better. And it's even better if you don't borrow only A, but you borrow token A and token B with collateral A plus B, with collateral LP token AB. And in that case, liquidation is the yellow curve, and you can see that it becomes a very, very unlikely event. So you can ask me now, why would I borrow A plus B with LP token AB as collateral? Do you have any idea? Exactly, leverage. If I have brought liquidity to a liquidity pool at Uniswap, for example, for a value of 100, and I want to maximize my APY, I can leverage my position by using borrowed fund, more ETH and more USDC, and deposit again in the liquidity pool. So I can increase my position. I have new LP tokens. I can come back to Secured, get more ETH and more USDC, and do a loop. Actually, we can do the leverage automatized directly in Secured, so you don't have to do the loop. You can do that in one transaction. You can top up your position times 5, times 10, depending on the pair, and you get this leverage position. So here we can see that LP token is a very good collateral for minimizing the probability of liquidation. Now let's look at rule number 2. Rule number 2, if you remember, this is minimizing the loss in case of liquidation, and by making the conversion between the collateral asset and the loan asset as easy as possible. If you look at LP token, you don't even need a liquidator. When you have to liquidate LP tokens, you just take the LP token, you go back to Uniswap, you give them the LP token, and you can withdraw ETH and USDC, and you can pay back your 2 loans. There is no conversion, no restriction on timing. You can do it immediately. No impact on price, which is very important because you're not causing any cascading liquidation, as we've seen with other protocols. So it's a very seamless liquidation process that you can do for any size without doing any impact on the market. So it's a perfect collateral for rule number 1 and for rule number 2. Conclusion, it's a perfect collateral. Based on this design, you can build very strong value proposition both for lenders and borrowers. For lenders, you can build the safest lending protocol because there is no liquidation, so they will have no loss on their deposit, so you can give them some capital protection. Actually, if you dive a little bit in our white paper, you will see that we add 3 other levels of capital protection to this one. But what we want to do and what we target is really to give a product that is for risk-adverse investors, just want to find a safe place for their token and generating passive income. For borrowers, you give them capital efficiency, meaning that if I have only 100, but I want to generate the maximum APY because I'm a professional market maker, then I can use this protocol to leverage my position and find the right balance between the risk and the return that I want to have. So it's much more adaptable to my position. This protocol will be live in the coming months. So if you're interested by what we're building, please check our website and have a look at our white paper. And if there is any question, I'm happy to answer them. Thank you.
Thank you. How are you calculating parameters of your protocol? I mean, like collateral factor and so on.
Okay, so that's a very good question. Actually, the parameters on the liquidation threshold, at which level I will liquidate your position, will be based on 2 factors. We have a rating methodology to rate LP tokens based on the volatility and the liquidity of the pool. If you have a very stable pair, let's say USDC, USDT, you have a super AAA rating on the volatility side. And if the pool is large, you can have a AAA rating on the liquidity side. In that case, I can give you like 20 times leverage. So your collateral factor will be around 105%. Okay? If you have a much more volatile pool, let's say ETH USDC, then you will have less leverage possible. It will be like time 5.
Any other questions?
Yes. Here.
Hi. Are you guys also planning to support single asset collateral types like A tokens, C tokens, or deposits in like Maple Finance, for example?
Actually, any token where I can get back the underlying tokens to pay back my loans work with that design. This is really what I'm looking to find. Correlation plus easy liquidation. If this fits in that design, I'm thinking about some tokens for strategy vaults, for example. It can work as well. So this is providing leverage for this kind of strategy, yes.
Awesome.
We are also planning to, so we have a test version on UniV2, and UniV3 is coming in the coming weeks as well.
Hi. I'm curious, what kind of oracles do you use, guys? And the second question, even if you have ETH and staked ETH, for example, liquidity for staked ETH apparently less than for the ETH, and in this case, you can still manipulate staked ETH, and the correlation will break. What's your perspective on that issue?
On Oracle, I'm not too worried about the price of the assets because this is the same assets that I will use to pay back my loans. What's important for me is what is the quantity of ETH and USDC I will retrieve if I liquidate my LP token. So this, I can rely on the data that I get directly from the DEX that will tell me at any moment, any block, how many tokens I can retrieve by unwinding my position of LP tokens. So I don't need external oracle to validate that.
Yeah, my question, like in the past, we noticed some of the major liquidation was actually caused by some kind of security incident when the underlying pool itself is broken. Yeah. Have you considered this as an extreme test case? Because when that happens, your LP token cannot be easily convert back to the thing you want.
True. There's two answers for that. The first one is we're going to focus on very famous decentralized exchanges that have went through all the security audits that we feel comfortable with. The second answer is we're going to use diversification, meaning that if you have deposited ETH, you will not be collateralized only by the LP token ETH-USDC from Uniswap. You will be collateralized by all the LP tokens that contain ETH in the pair, meaning that even if there is one LP token that goes bust, it will impact only a small portion of your loan. So we'll minimize the loss in case of liquidation by doing this diversification. So it's diversification for lenders. As a lender, you will be diversified in terms of collateral, but the ratio stays the same for the borrowers. The borrowers will have one LP token and one loan in face of it. So each LP token will be managed separately for borrowers.
Any other questions?
Oh shit, I forgot what it was. Oh my god, I'm sorry.
Okay, come to me if it comes back.
The borrow asset, so is that based off of like a similar model to like Aave or Compound where people have to come in and lend the asset and that they earn interest based on like a utilization rate model? Or how does that work?
Oh, you mean the interest rate model?
Yeah, for like if I'm depositing a WETH correlated LP token and borrowing WETH, like where does that actually come from?
Exactly. So your interest will come from the borrowers, and the level, the interest rate that the borrowers will pay will depend on the utilization rate. But we have a different formula from Aave and Compound. We're using the fact that if the rate, if the interest rate is at 0%, the utilization factor should go to 100%. And if the interest rate is like 100%, you think that the utilization rate should be at 0. So you have two fixed points on your utilization curve, which is 0, 100, and 100, 0. And then you can make some linear interpolation of your interest rate so that you can converge to an optimal utilization. Why do we need this optimal utilization? You don't want all your funds to be borrowed by borrowers, because if lenders want to go out, there is no liquidity in the pool. And you don't want to have 0 utilization, because otherwise you won't have any passive income. So we are targeting some optimal utilization around 70%.
So, friends, if no more questions, thank you.
Thank you very much.